Now let's talk about the characteristics of stock. So there are a few terms that we need to know, which includes authorized, issued, outstanding, and treasury stock. So the number of shares of stock that a corporation is authorized to issue is stated in its charter. The term issued refers to the shares issued to the stockholders, which is part of the authorized. One thing that you need to know is that we can never issue more stock than what we are authorized to issue. So a corporation may reacquire some of the stock that it has issued, and in this case we call it treasury stock. The stock remaining in the hands of the stockholder is then called outstanding stock. So let's see the next diagram. I think it gives us a better idea. So let's say we are authorized to issue 10,000 shares. So the yellow line here, or the yellow circle, is the one that represents how big we can go, which is 10,000. So we issued, let's say, a little bit less, which is 8,000. Can we issue more than 10,000? No. So the most we can issue is the amount authorized to us. But in most cases, companies would have like something below than what's they are authorized. So they issue a little bit less. So let's say we issued 8,000. And then we bought back some of what we issued, let's say 1,000. These bought back shares, we call them treasury stock. So the remaining would be the outstanding, which would be 7,000. So the authorized in this case is 10,000. That's the most we can issue. Let's say we issued 8,000. So that's the green circle. Then within, let's say we bought back 1,000 from the market. Then the left, what's still outstanding would be 7,000. And the 1,000 that we bought back, we call them treasury stock. So shares of stock are often assigned a dollar amount. We call it the par value. Stock issued without a par is called no par stock, and some states allow you to do that. So in some states, the board of directors of a corporation is required to assign a stated value to no par stock. And from an accounting perspective, we treat the stated value the same as a par value. But some states, they don't have a par value, they don't use a stated value, so we just go with what this stock was sold for. So to protect creditors, some state laws require corporations to maintain a minimum amount of capital or paid-in capital. This minimum amount, called the legal capital, usually includes the par or stated value of the shares issued. The major rights that accompany ownership of a share of stock are as follows. There are three major rights. The first one is the right to vote in matters concerning the corporation. The right to share in distributions of earnings. So whenever there is a distribution of dividends, we have the right to receive dividends. And the right to share in assets upon liquidation. So the worst case scenario, if the company files for bankruptcy, then you have the right to share in assets upon liquidation. Now let's talk about different types of stock. And the commonly known stock are common stock and preferred stock. So when only one class of stock is issued, it's called common stock. Each share of common stock has equal rights. So we cannot have like a big common stock and a small common stock. They all have the same value. If you want to have more equity, then you buy more stock of common stock. So for example, you buy like 5 stock versus 1 stock to have more equity. When a corporation issues one or more classes of stock with various preference rights, such as a preference to dividends, such a stock is called preferred stock. So one thing I want you to know, we cannot have preferred stock alone. So it's either common stock alone or common stock and preferred stock. So the dividends rights of preferred stock are stated either as dollars per share, example $4 stock for a $50 par stock, or as a percent of par. So we say preferred 8% stock for a $50 par. So in this case, it pays 8% of the $50 par, which is also equal to $4. So it can be stated either in dollar value, like the dividends here, or we can just state it in a percentage, which is basically multiplied by the par value. Preferred stockholders have first rights or preference to any dividends, and therefore they have greater chance of receiving dividends than common stockholders. However, since dividends are normally based on earnings, a corporation cannot guarantee dividends even to preferred stockholders. So this is different from interest. Like if I'm borrowing money from a creditor, I have to pay the interest. I don't have a choice. Same thing for issuing bonds. But if I'm issuing stock, preferred stockholders, they have the priority or the preference to get paid first. But the board of directors can decide that we are not going to pay dividends this year. And in this case, the shareholders or the preferred shareholders are not going to receive any dividends. So as you can see here in this diagram or this figure, we have the money available for dividends in this booth, and those in the front of the line are the preferred stockholders. Those are in the end of the line are the common stockholders. So they get to take whatever left after is given to the preferred stockholders. Sometimes actually what's left to the common stockholders could be more than the preferred stockholders' dividends. So the payment of dividends is authorized by the corporation's board of directors. So when authorized, the directors are said to have declared the dividends. And I want you to know this expression, declaring the dividends, because declaration is different from dividends payments. So when you declare dividends, you're just saying the company is going to pay dividends on a specific date, but they're not actually paying the dividends yet. So they're only creating a liability. Cumulative preferred stock has a right to receive regular dividends that were not declared or paid in prior years. So as I told you before, sometimes the board of directors would say, we're not going to pay any dividends this year. So if this happens, and the preferred stock has this cumulative feature, in this case, their dividends is going to get accumulated for them. It's not that they're going to lose it forever. So whenever the company declares dividends later on, then the preferred stockholders are going to get or receive the dividends for the years they missed. In other words, they call it dividends in arrears. So again, non-cumulative preferred stock does not have this right. But cumulative preferred stock dividends that have not been paid in prior years are said to be in arrears. So any preferred dividends in arrears must be paid before any common stock dividends are paid. Any dividends in arrears are normally disclosed in notes to the financial statements. So in the footnotes of the financial statements, this has to be mentioned. So let's see as an example. Assume that a corporation has issued 1,000 shares of cumulative preferred $4 stock 50 par. This means that they're going to receive $4 for dividends every year, and 4,000 shares of common stock at $15 par. The corporation was organized on January 1st of year 1 and paid no dividends in year 1 and year 2. So now we can tell that there are 2 years in arrear for the preferred stocks. So in year 3, the corporation paid $22,000 in dividends, of which $12,000 was paid to preferred stockholders. Why is that? Because if we do the math, we have $4, 4,000 shares, so they have to get paid $4,000 for year 1, $4,000 for year 2, and these are $8,000 in arrear. And for the current year, which is year 3, they also have to get paid another $4,000. So that would make a total of $12,000. $8,000 in arrear and $4,000 for the current year. And the leftover out of the 22 now is $10,000. That was paid to common stockholders. So now let's see how it can be presented on a chart. So the total dividends paid is $22,000. For year 1, we have in arrears $4,000. For year 2, another $4,000 in arrears for the preferred stockholders. So you can see that the total for the first 2 years is $8,000. And then for year 3, the dividends for preferred stockholders for the current year, which is $4,000. So that would make up the total of $12,000. So subtract the $12,000 from the $22,000, and that would give us a leftover for the common stockholders of $10,000. So that's going to be what's going to be paid to the common stockholders. So as you remember, preferred stockholders, they have the priority. They get the dividends first, and then the leftovers should go to the common stockholders. So as a result, preferred stockholders receive $12 per share, because if you think about it, $12,000 divided by 1,000 shares in dividends, while common stockholders received only $2.50 per share, which is the 10,000 divided by 4,000 shares. They don't get any kind of in arrears kind of dividends, because if they don't get paid in a certain year, which is year 1 and year 2, they don't get paid. So in addition to dividends preference, preferred stock may be given preference to assets if the corporation goes out of business and it's liquidated. However, claims of creditors must be satisfied first. So, as I said, preferred stock, they have preference over common stock. But one thing we also need to remember, that creditors, they have preference on top of both of them. So if the company files for bankruptcy, creditors need to get paid first, then the preferred stockholders, and then finally the common stockholders. So let me stop here. In the next video, we're going to be talking about issuing stock.